you. Thank you very much. Good evening. Thank you to Global University for giving this chance to walk through together the great financial crisis. Just before we start, I just like to give, is it working? To give a little view on my profile. You have a view of the place where I grew up. And I can tell you it's better from the skies than on the street. But I thought that's fine to show it. And I have two half children. And in that case, it's more than one. More importantly to you, I have came through 8 major financial crises, which is about 1 every 2 years. And that's something I'd like to insist a little on. And the most important thing is when the Japanese bubble crashed, I was on an audit assignment in Tokyo. And it was all the time like that during my career, so I feel somewhere that I am responsible for all those crises. And that's a bit of a problem. And then you got all that already. Now, yeah, it's on. Anyway. This is what I propose to you is first objective to provide you with an insight on what happened to Lehman Brothers. That would take about 40 minutes, the biggest part, and a short second part try to draw some lessons for the future if we manage to do that. What happened to Lehman Brothers? Let's start by reminding a little what the Lehman shock was. You remember probably how it looked like. I can tell you that internally it was a massive shock for people as well. And there were a lot of expectation about an acquisition, about survival during the summer, and the announcement of the bankruptcy caught everybody in surprise. Everybody was expecting a rescue or something. So what happened is that what is called the interbank market froze, and stocks and bonds fell. The interbank market is the place where banks lend to each other to fill in the lack of deposits, for instance, or because they need resources for their new activities. And this stopped, simply stopped. There was a panic, simply a panic. Why? The first thing is that banks don't know how much another bank owe or own in Lehman Brothers. So if you lend to a bank, you don't know if that bank is going to be alive tomorrow. So just credit suspended. And there were rates, interest rates quoted. They were just opinions. They were not real transactions. And another thing is, you had in these financial markets hundreds of thousands of deals that were awaiting confirmation. What is a confirmation? That's very simple. For instance, if you buy a book on Amazon, you receive an email that says you bought a book. Banks will do the same. The only difference will be that you will send an email back to say, I've checked all the terms and I agree. And this is important because this is the legal validity of the transactions. And because of the growth of financial services, all administrative departments were underwater. So there were a lot of transactions non-confirmed. This added to the panic of banks. And so we ended up with major banking systems, except Japan, ending in emergency rescue from their governments by mid-October, as you know. So let's see why we had such a problem and what happened. It's very simple. There were two key factors leading to collapse. The first thing is that we had a very unusual worldwide bubble that exploded. And the second thing is that we had a very large bank with a unique culture. And this combination of an attitude and the size that was also an important factor as we will see. So let's see first what happened in the market. Very simply, what is a bubble? It's very simple. You know that if demand for asset is higher than offer, then price go up. And if there is always demand ahead of offer, then price continue rising. And how do you keep demand ahead of offer? Then simple. You lend to borrowers and you lend to buyers. So you lend to buyers and you have a pile of debt and asset prices rise. The trick is, and we will see how, that it will necessarily fall at one point. You know, at the beginning, for instance, take the example of a house loan, and it's the same for any sort of asset, absolutely the same. You can take the most complex product, that's the same. You have your home, maybe I'm going to use that. You have your house. You bring savings, that's the equity, and you have debt on it, and at this point, it's normal. The next stage is that new borrowers and lenders are more aggressive and optimists, more and more. So what happens is the price of the houses go up, and the equity, the savings that you need to get a loan is lowered because lenders are happy with that. And you've heard the word of subprime mortgage. I think I owe you a little definition for that. You keep in mind what a subprime means. It's related to the mortgage loans in the US. You have prime mortgage. This simply a certain number of criteria, as you can see. At least you bring 10% of savings or down payment, and your debt service doesn't exceed a certain level of your income. And then the loan size is under a certain size. There is another thing which is called Alt-A mortgage, like the keyboard on the computer, the key Alt. This is a situation where basically this is close to prime mortgage and there are not all the criteria filled in. And then what is subprime mortgage? It's everything else. For instance, a young physician working for a very famous hospital has very high income prospects in the future. He's a subprime lender, but it's a good credit. Then you have low-income families, but with excellent credit record. In the US market, it will be financed outside of the prime mortgage, and it's a subprime mortgage. So far, so good. Then you have also what has been called as ninjas. Maybe you heard the term. It's no income, no job, no asset. And it's someone who comes from nowhere and flies by night. And what happened with those credits is that they fall in foreclosure. They don't reimburse, so the bank sell the property. But there is debt left, no more equity, and a difference because there's a loss. And if this happens in a local economy, what happens is people start losing their jobs, so they cannot repay. So at the end, there are more and more sale of houses, and the market falls straightforwardly, and as you see, it necessarily happened. And why have we so much debt accumulated? Why can this happen? That's very simple. It's because the interest rates are too low. And just to show you very quickly, between 90, this is not correct. This is 95, sorry, very sorry about that. This is 95, and this is 2010. And you see that long-term rates, this is the US rates, have been almost down all the time. And whatever the short-term rates are, long-term rates keep at a very low level, and they don't move up when the authorities start increasing short-term Fed fund one-day rates to try to juggle, to stop the bubble. And this was in 2006. And why had we for so long so low interest rates? And I think that's a key reason, if not the key reason of the crisis. Is it tolerance for high inflation? Say, we just tolerated a high inflation without raising rates? No. Inflation was very low. Was there economic stimulus? So we maintain interest rates low to have a better economy? Yes, but it would not have lasted for 5 years or more. It's because there were an excess of capital in the market. And this comes, one big reason is the US foreign current payments. Europe as well has a deficit, but was in deficit all the time. Current payments is trade, services, interest, dividends. And basically, if there is a deficit, somewhere there's a surplus. It means a country will not, with a surplus, will just leave the money like that. So will not settle the deficit in any way by buying goods or services or whatever. And this money flew in the US and European markets. And you see that China foreign reserves went up dramatically to $3 trillion. And Japan foreign reserve as well went up from $100 billion to $1 trillion. So this is exactly the compensation, well, not exactly in figures, but this is one of the major compensation for those deficits. The problem is that with this very low interest rate environment, there was another factor. It was not all. There was a deregulation in the financial sector, and we will see how it worked out. You may say that there were a lot of the bank is a regulated industry with a lot of reporting to be done, a lot of rules and laws, like drug industry. That's true, but for more than 10 years there were a continuous deregulation process. The first thing is that both in Japan was less concerned by this, but in the US and Europe as well, there were more competition in investment banking. And because commercial banks who traditionally just get deposits and make loans were allowed to enter the investment banking market, creating a lot of competition. And also, there were less and less capital needed per dollar of risk. You may know that banks have to build up capital to equity to keep to regulation requirements. But actually, the regulators accepted that banks used their internal models to assess the capital needs. So suppose you're a bank and you have an asset or a corporate bond of 100. In front of it, you have to have regulatorily 8 in equity. This is a requirement. Suppose now that your model says that the maximum loss you may risk is 50 in most of the cases. You tell the regulators, my real risk is 50. The regulators say yes. The international regulation says yes, and there are reasons for that. Most of the time, in 95 or 99% of the cases, it's true. You just need 4 of capital. So you continuously lower the capital needed by refining your models. And the bubble was exacerbated and underestimated by that. And this is a vicious circle because we saw that there were high competition. You will say there was a lot of capital coming in, so there shouldn't have been competition. But actually, what happened is that because the rates are very low, it's very difficult to give high return to investors and to give a return. So there's a lot of competition to provide investments that give better than the short-term market or even the 10 years market. And because of that, there's, for banks, this is for banks, a low return on their assets because they create a lot of offer and they have a low return. So you know, it turns around and they are incited to create assets through financial innovation. And this can be seen through one example. You have Bank A wants to reduce its risks. She has a risk on corporate X. It purchases to Bank B an insurance, which is called a credit default swap agreement. It means if corporate X collapse, then Bank B will pay an agreed amount to Bank A, and Bank A pay a premium for that. Then Bank C has heard that Bank B sells insurance. It has no exposure on corporate X, but it buys an insurance because it thinks that there is a good chance that corporate X get a problem. It's just like you think that Osaka will have next year a lot of fire. And you call your insurance company and you say, I'd like to be insured on Osaka. So normally the insurance company will tell you, what property do you have? And let's see the amount and blah, blah, blah. You say, no, I have no property, I don't care. I just want to be insured if Osaka gets in fire. You will say, in insurance world, in casualty insurance, it's not possible. Well, in banking, it is more than possible. It's a very, very common product. You insure yourself on an asset you don't have, totally without any problem. So you have, with this low-risk environment and the competition exacerbated between banks, an increased asset creation. And then the banks have a problem because they report, anyway, at one point, they report their assets to regulators. So they have to be careful because they need the 4. You remember, they should have 8, but they need 4 in equity anyway from their assets. So if the assets come to 200, it's not easy to raise capital from 4 to 8 overnight. So you have a struggle to reduce the assets on reporting dates. And this one is very, well, it's very simple. It has become very simple. Something you can do is what is called a total return swap. It's very simple. The principle is you have an asset, and it's not a good asset. It's very, very bad. It's, you know, it's non-investment asset, bad asset, not very good. Well, you enter into a contract with another bank, which is not from your country or which is in a position where they have good assets, they're okay, or an insurance company, or a hedge fund. And you say, we make a contract. Bank, let's say it's an insurance company because you will buy an insurance. You pay a premium, an insurance premium. The insurance company or the bank guarantee that if the bad assets have a problem, they pay you. So they will pay the asset if problem. So in a sense, once you have entered into that contract, you no longer have any risk on the asset, right? Because if there is a problem with this bad asset, it's guaranteed, provided the insurance company is okay. Then, of course, the insurance company is doing that for a premium, but you want the return on the asset. So on top of it, and it's just a calculation after that, it's, you know, a sort of black box calculation. The question is that the insurance company needs to pay you something, and what they pay you is the return of the asset. That's the way it's done in the market. That's why it's called a total return swap, just what the insurance is paying you. Because you're doing that, when you report at end of month to the regulator, your list of assets, this one has disappeared, totally disappeared. But this contract, of course, you imagine it's a cost, because if you pay the premium definitely, it's just like selling the asset. So you just do that for 2 weeks. And then, or even, you know, 1 week or sometimes 4 business days. And then you see what you do at the next reporting date. You hope that maybe the asset will be sold to some investor or someone else who will have to play the game in turn. So that's, sorry to have taken some time on that, but that's a familiar way of doing that. There are other ways that's been criticized. This one is a normal product. It's not been criticized. You know, I emphasize the the problem it poses in the market for monitoring from a regulatory perspective. But there are other things. Maybe I should mention that. One way, how do banks, and especially investment banks who don't keep, investment bank and commercial bank, there is one difference. They don't keep the assets. They don't keep it. They sell all the time. They sell, they sell. Commercial banks, they have deposits, so they keep the assets until maturity, but they sell. And how do, for a couple of days or for 2 weeks or for 1 month, they're waiting the due date that investors already, because they got a request from investor, like an insurance company, a fund, mutual fund, whatever, and they get the asset, they carry it for some days, and then they have the sell, so they sell it. But meanwhile, they need the cash, right? They're just financing the business. The way they do it very commonly is what is called, sorry, that's a little technical term, but I think it's good you get it when you read specialized newspaper. It's called a repurchase agreement. Repurchase, it means what it means. It's simple. You have an asset. You sell to a bank that's willing to buy it, and usually it's a good asset. This one is a good asset. You sell it, for instance, at 100. And you commit to buy it back. You say, I'm going to buy it back, say, in 2 weeks' time, or in 1 month. Typically, can be more. And you buy it back. This is called a repurchase agreement. And if the rates are 2% per year, basically, and you sell for 1 month, you buy it back at 99 point, for instance, 0.98, very, very small price. Because this is a very small difference in price, the accounting rules will say, this is not a sell. You're not selling the asset. You're just getting a financing. And this will stay on the asset list. This will stay on the balance sheet. Now, there was something that Lehman Brothers used, but actually all banks used. And the US regulators were not specifically focusing on. This was called repurchase agreement. We call it in the jargon repo 101. Why? Because it's 1%. In that case, I sell the asset, the good asset, for 100, but I buy it back for 99. Now it's for 2 weeks, typically, 1%. This is 30% per year. This is extremely expensive. You're desperate when you're doing that. But the accounting rules say, because the difference in price is very big, it's just like you're selling the assets. Probably you will not buy it back. So you're allowed to just scrap it from the balance sheet. It goes out, disappear. So in a normal transaction, you have assets sold under repurchase, and you have financing. With this kind of transaction, you have no asset, and you have cash. Well, you've got, instead of, you have nothing here, instead you've got cash here, instead of the asset. So in this situation, you cannot read the balance sheet. But technically, this is perfectly correct. And This has been changed since the crisis. But one reason why banks could accumulate so many assets was because they could do this kind of transactions, which were initially done for industrial corporates. So what happened with the worldwide bubble? We had huge trade imbalances for a long time, low rates for too long, easy borrowing. That creates leverage, a lot of debt on equity, compared to equity. Deregulation of financial sector, that triggered first competition, lowering the yield on assets, the return, and a lot of asset creation, because there was a lot of possibilities to manage those assets without having to even mention them. Then Lehman Brothers didn't go away or didn't create that shock only because of the environment. The environment is one factor. The second one is it was a very large bank aggressively engaged in that business. Here you have the ranking of banks in 2006. It's very stable. Well, it's not stable, but it's more or less the same through years. And this is for the world, the United States market, bonds, equity. This is mortgage-based securities. It's mortgage-backed securities. It's basically mortgage loans built up into notes and sold to the market. And you see that Lehman Brothers was quite a big player, including this mortgage market, but you see other banks here that were large players. So it was obviously one of the large players. This ranking is published every quarter. This is for what is called primary markets. What is a primary market? It's simple. You have companies that issue new bonds or new stocks, and investment banks, they buy it with the intention to resell. So this ranks the amount that they bought on those new issues, and especially for one full year, this gives you how they compete for an important part of the market. So definitely within the number 10 player in the world. And 600 billions of assets. The US GDP is 14 trillion or 14,000 billion dollars. And the net US debt is 50% is 7,000 billion dollars. So this is close to 1%. This is huge for a single firm, and all large banks are like that. They had already closed market shares close to that in 2000, but those market shares were improved despite new competitors or bigger competitors with what is called universal model, which means they do at the same time commercial banking and investment banking. So they have deposits and they have a larger access to funding. It means to me that in 2008, they were perceived as too big to fail and to fall by the banks and the other insurance companies and funds, etc. So you see how much they enjoy growth over 10 years. 94 is the year when they get floated in the market. Before that, for 10 years, they were owned by American Express. And you see that they had a very huge growth in net revenues, 40% growth per year, sorry, 15% growth per year. But this is in the average of the market, a little higher. The market itself was very, very good for banks in general, in the world in general. And you see that net income had a very big progression, except, of course, the last year. So it was in line with the sector, but it was among high performers. Income per employee was second only to Goldman Sachs. And they had 30,000 employees. So it was really a business model dealing with large investors, doing bulk transactions, and all the range of products with a lot of added value per employee because of the size of transactions and sometimes the complexity of products. What does it mean? It means they had a faster market penetration than most of the competitors, and they had also a faster asset turnover. And this was not only because the market was favorable. They had a strategy, and we had a strategy, which was to grow faster than competitors. And why do you want to grow faster than competitors? Not because you're afraid of something also, not in banking. Usually in banking, you need competitors. You need them because you share risks. If you cannot share risks, suppose there's only one bank in the world, this bank will be desperate. Because there's no one you can share the risk with. So usually banks, they like to have competitors. But a key thing for Lehman Brothers was to stay independent as an investment bank. Most of the banks were, investment banks were bought. Smith Barney was bought by Citi. Another example is JP Morgan that was well, acquired or merged because the size was big, merged with Chase and have a multiple model. Many examples. Goldman Sachs, Bernstein, and Lehman Brothers tried to keep this independency. Well, this is only a part of the explanation for the collapse. Actually, before things turned really bad in 2008 and summer 2008, there were problems that were seen but were not voiced well enough to management and not heard. And we'll see there's a culture of things behind that is important to see whether this kind of situation can be prevented in the future. Problem was seen. There were different departments like risk management, etc. An example is internal audit. Internal audit is, external auditors check the accounts, the financial statements. Internal audit basically has a rather more holistic view because we will look at business prospects, the risks in the business is whether it's aligned to the business strategy. We basically discuss everything. So sometimes we focus on problems that are still limited in size, but are going to create future issues for management. And internal audit in Asia, but also across the world, alerted that the P&L, profit and loss, was increasingly uncertain. What does it mean? there were two issues. One is, like in every banks, option business was growing, so there was a question of whether these optional results are really sustainable and when it will be cashed. But another thing is, the way it works is you have business people which are facing the investors or trading in the market, traders. And they report their results every day. And you have administrative people who check that it's in line, especially in finance department. There was a large turnover, and there were a growing portion of the daily profit and loss that were not checked properly. And you know, Asia was about 10 to 12% of the net income of the group. And in 2007, we had a problem on something like 30%, which is huge, of the original result, which is 3 to 4% of the group. So at the total level, the external auditors say, well, it cannot do anything because they raise the issue internally, but they cannot voice it outside or whatever because it's under 10%, even under 5%. They cannot consider it as material. Another thing is, we called in 2006 with my colleagues in London, in New York to some extent, but more importantly in London and Asia, that for sensitive areas, the budgets are just put flat. And we stopped just a little hiring, which is sort of overstepping the rule of audit, sort of going into management responsibility, but just suggesting that we fix the internal issues on very sensitive areas, so that the budget is, and which would still be a record results, because it's been record results on record results. Another example is, in first half of 2007, some transactions large transactions became difficult to refinance. There was already, because the crisis in mortgage itself, the banking crisis was not yet there, but the crisis in the mortgage and loan, housing loan market was already there in the United States, in the UK, in Europe. So some banks started feeling difficult to provide liquidity, and we questioned some ways liquidity was provided. But it was not voiced well enough. A first issue is that internal audit was a lot of distracted by different roles. One thing is, it's an irony, is internal audit had spent a lot of time, in 2005, about 70% of the time, to check the internal control for the reporting according to the Sarbanes-Oxley law, which means that a new addition in the financial reporting statements. This small piece took actually a lot of work on audit, and other banks have used external consultants and could perform audit role more effectively. And there were a clear problem with that, because internal audit had sort of financed this effort. Also, we tend to carry, and that's a lesson for internal auditors in general, to carry messages through technicalities. So it's not clear enough for management. And the reports are standard, nobody pay attention. We suggested to put a line of message to management in the email, but basically we want to stick to a standard. And this is bad, because this triggers us into into routine, and internal audit should be anything else than routine. And this difficulty to voice problems were coming more and more within the firm. Well, the same for risk management, business development. Messages were not heard. Obviously, we've seen there were some governance issue. What is governance? That basically how the rules are defined. It's not necessarily written, but it's how things are working between the top management, the shareholders, the board, and also top management and management inside the firm. And it proved deficient. How was it at Lehman Brothers? Well, actually, there is in the United States rating agencies for corporate governance. One big one is Investor Services Investor, I forgot the second S, anyway, Services. They provide a rating on governance, on the quality of transparency of a firm. And Lehman Brothers was one of the top in terms of complying with the rules, the guidances, the laws. And this rating was renewed in September 10th, on September 10th. So you imagine just 2 days before, no, a week before bankruptcy. But their directors were not meeting frequently enough. For instance, there is a risk management committee on the board. They were meeting basically twice a year. I realized that by the end of the period, you know, because when you're in the day-to-day business, you know, and that's something I should have picked up much earlier. That's a learning for me, but you cannot imagine it. I mean, a risk management committee on the board of a major bank should meet every week. Should meet every week. 10 minutes is enough, maybe, but every week. That's unbelievable. Many directors were in position for 15 years. That's fine, but they get used to it. And feedbacks from also, there was an audit committee that the audit was reporting to. The feedbacks from audit committee were good, you know, on internal control. What is internal control? Probably, you know, it's how processes are in control or well checked, etc. But on market risks, governance issue, there were no questioning, and there should be. Also, something strange is that in 2008, the culture became very much aligned. You would say it's good for a firm to be aligned. But this is amazing considering the diversity of employees. Because Lehman Brothers has a large diversity of employees and is hiring a lot. And here, I just put on a table the key cultural aspect of Lehman Brothers. And I try to compare it with other banks I have some clue on, so sufficient clue on. There was a lot of communication and totally fluid. If I want to call the CFO, if I want to call anyone in the firm, probably not the chairman, but almost every level, I can, except from March 2008. Of course, you need to have a good reason for, but basically, you won't be, you know, it's not imaginable in other firms. And you cannot imagine that. And there was no bureaucracy. Basically, there was a lot of very efficient decision-making committees on transactions with a lot of information. But the problem is that all those information, they were not organized into a full system by topic, so that could have supported the running of the whole bank. And each function, like administration, finance, IT, had a legal, they had their own systems, organization, but the wealth of information we had through those committees were basically followed. It was followed, but it was not used as a necessary information to run the bank. And as on the other side, there were not a lot of written procedures, this turned out to be a weakness. This is a strength for a company, those two things. It turned out to be a weakness when crises come. There was a strong track record of success, you've seen that. Strong self-confidence, extreme self-confidence, because they went through a very difficult time in '94, where no one wanted to extend credit, and then the market became very favorable to Lehman Brothers, who got a very high rating. It has an outlier personality, just alone in the market. For instance, when I was at Société Générale in the strategy part, my time with them with the strategy, because SocGen had a problem with investment banking, which was already large, they wanted to make an alliance under a certain form. And we tried to have Lehman Brothers making an alliance. And the chairman met with the chairman of Lehman Brothers on an annual meeting of the international bankers. And we organized that. It took a lot of time. But the answer was, we're fine as we are, and we will never need anyone. So we're just continuing. So this turned out to be a very big problem. So you see that we had a very large bank engaged. Too big to fail is not a buzzword. That's what happened. The growth was a strategy, not only a result. Governance definitely too weak. And the culture ended working against the firm, while at the beginning it was good. So we don't have much time for the lessons, but let's try. I have basically as lesson 3 basic questions that are very common now. Can we detect better bubbles, reforms of financial markets, and more efficient corporate governance? I will go very quickly on that, but the message here is that because the G7 is in a recession, and probably because of the debt accumulated with the bailout of financial system and stimulus of the economy, we will get inflation when growth comes back. The next bubble seems maybe far away. But in emerging countries, there's still a question, because this is the real estate situation. This is from 2009, 2001 in Russia, the BRICS, you know, Brazil, Russia, India, 2010, China from 2003, and you see from 2010 here again. So the good news is that there was a correction on stock markets. And it seems there's no bubble on the stock markets for emerging countries. I mentioned that those accounting tricks were no longer afloat. So there's been some reform, but there's no key text yet implemented. And especially in particular, the American Securities and Exchange Company has to implement a very important law to protect investors, which is called the Dodd-Frank law, Dodd-Frank Act. A problem is that they may run a bit late. So I'm not sure they will meet the target of next year, 2012, and the crisis is 2008. It's already 4 years. And more importantly, you know, large banks now, they need time before being able to absorb more stringent rules on capital. Because we need to have banks with more capital buffers, less what is called leverage, definitely less leverage. That's a basic thing, you know, we can talk of more sophisticated problems, but basically banks have to, how it is said, deleverage. They have to reduce the size of the assets for capital. They have to find ways to raise capital. They have raised capital already, but not enough. And now they're not in a position to do anything. And we don't know when they will be in a position to better up. So once again, the priority now is to carry bank losses through national debt. That's a very difficult situation to, impose new regulation. So what I believe is the only way to come back to confidence and to sound financial markets, which are needed for businesses, is that it's governance. Because taxpayers, they must learn that regulators, they are no one. They are the last resort lenders. And rather than asking piles of reporting that anyway are not read, and usually after a couple of years on the reporting, you hear a message from the regulator that says, stop sending that. Let's keep doing it, but stop sending it. Anyway, we don't have time to read it. It's better to claim transparency. And also investors must learn that a board needs proper information from inside. So governance will start with, we said board members at Lehman Brothers, they were here for 15 years, but it's not a problem in itself, and it goes beyond, it's all the rules and the working situation and the culture I mentioned. And I would end with an image which, as you know, the governance is just like the windshield on a car. And probably audit is the wiper. Try to clean it properly. It's one of the wipers. A bank is a car that needs a lot of wipers. And so the lesson for future is that I'm afraid we forget in developed countries what a bubble is. Reforms, I'm afraid they have lost momentum. So we are left with corporate governance. And I guess that will be up to you to do something about it, because it's now up to the next generation. Thank you very much.
Your comments.
Thank you for your patience.
No, by no means. You left us with some things at the end that we would perhaps like to pursue more. One thing that I noticed as you were giving your explanation, you suggested that the crisis occurred in part because the central banks in North America and Europe provided very low interest rates, basically provided, yes, that's a little different, basically provided very easy money, and so interest rates low, investors were chasing yield, and it created bubbles. Money was going places like housing and the like. And you also said that deregulation was a factor. So you've essentially laid out kind of an excuse for the bankers. And yet we had homeowners who were doing things that were irresponsible, and we had bankers who were professionals. Can't you hold them a little bit more accountable?
Well, I think you are right. Minus multiplied by minus is plus. There were deregulation. Beside that, there were no regulation on bankers, traders, and probably that was a lack, and that there have been abuses. Of course, greed has been a part of the crisis. A problem is if you do well as a trader a year, you get a bonus. If your firm is in trouble, or you put it in trouble, or you do poorly, you don't have to give the money back. So you have a strong incentive, first to show good results, second to do well. So I think you're right. That's something I didn't put a focus on that. I wanted to show underlying factors because I don't know how we will get rid of greed. You know, that's something in the world. So
Right. I don't think you will. No. I understand. You were explaining the context in which it occurred. It was much easier to occur in this circumstance. It likely would not have occurred had money not been so free, had we not had the unusual circumstances in interest rates. I was also struck by the fact that you didn't spend much time talking about the rating agencies. Now, the rating agencies have always been presented as the protectors of the investors, independent and professional, expert analysts, specialists in finance, and there are many pension funds and the like that have rules linked to the rating agencies, to their ratings on investments not permitted unless it has a bond has a certain credit rating, a certain level of credit rating. So the credit rating agencies, it seemed, should have done a better job. We know now that they were rating AAA, AA, single A mortgage bonds that ended up being worth from $100 face value to $5 and $10, worth virtually nothing. Completely wrong. Aren't they supposed to be a protector? Isn't this one of the failings of the system that also ought to be included?
Well, I didn't mention rating agencies, and I think that would answer your question, but basically for two reasons. First, I think it's long time there is no banker that follow the ratings any longer, probably since the MHE collapse, where they just downgraded in 2 weeks' time from top tier to the last in class. So. And maybe there are still some institutional investors who believe in them, but the other reason is that they have very, very good professionals. And all those transactions, like all the bond ratings, by the way, they are made under the assumption that statistically things will repeat. So it's not very good to protect against big shock. Little shock, yes. Big shock, no. And even for big shock, there was an assumption that because there are so much money and so interplay in the market, I think everybody absolutely, including myself, around 2006, 2007, and even since 2000, lost the view on the global picture, if you like, on the reality. So each transaction looked like, oh yes, statistically it's very robust. The problem is that those statistical models they are very weak in big shocks. And that was a minority school of thinking, and it has become sort of majority after the crisis. It's always after.
Exactly after. But another segment that we of the economy normally we depend on are the professional investors, like the pension fund managers and the like. But yet we find that in this U.S. mortgage crisis, it was the purchasers of these complex products, these complex mortgages and products built on mortgages. It was professionals. It were hedge funds. There were pension funds, all of whom are managed by experienced professional investors. Yet they were completely fooled, it seems. Were they fools, or were they fooled, or how do you see that?
Well, if you take away the Madoff case, which is very special, I think they tried to make reasonable investment, but they were in a market where there was one assumption, is that liquidity always exists. So they had an investment. If something goes wrong, they can sell it. And they have also traders who are ready to react very quickly in the market. The other thing is, as I said, for rating agencies, is globally they thought that if statistically something is robust, then they can explain it to their management. Then basically they feel it's okay. And it turned out not to be. Probably everybody was surprised by the speed at which liquidity disappeared.
No question about that. It disappeared almost completely. Central banks had to step in and with incredible purchases of securities, putting so much cash into the markets. Another thing I was thinking about when you were talking about the culture at Lehman, I'm from an investment bank, and I remember the situation with John Mack, who was the head of Morgan Stanley. I retired in 2007, so I got to watch this from the outside. But I remember that he complained bitterly about short sellers, and Morgan Stanley was not the lead target. The lead target was Lehman. Lehman was being aggressively shorted in the market. How did management react to this? What did you hear? What did they think? Did they think it was just rumor? Was it speculators trying to foment rumors to push down, or did they believe the firm was really substantially stable? Did they think there were real issues? What was the perception inside among senior management that you knew?
Well, I think there was no real change perception, but a different attitude. In 2007, Lehman Brothers had a mortgage lending business directly, subprime mortgage lending, which was doing good and had less problem than the other players. And because of that, they had a lot of information in the market. And they should have reacted. But in 2007, the crisis in real estate in the United States already here, and in the UK, in Italy, in Europe, basically. And they had shut down this business. They have taken losses. The net result was they were shutting. They closed the end of 2007, and they took losses. But they thought they're going to get out of this real estate crisis and go fine. Then in 2008, they were convinced that short sellers. Investment banks have been claiming for years that they are free to do short selling. So it was on corporate. So now it was just the turn of banks to be short sold. So they shouldn't complain. But um, they had a view that at the end of the day, they are very big. If this is a problem, this is a national problem or a world problem. And if there is a bad time, which is due to the whole system, they will be supported by government. And they thought probably because of that, they can bargain very tough. So they didn't change or I don't believe they made a lot of concessions to get rescued.
Wow, okay, I see. So they knew they were in trouble, yet they still were going to bargain tough because they thought the government would put taxpayer money behind them.
Well, to be fair, I would say probably not in the last 4 or 5 days.
I see, okay. I see, okay. You talked about the role of regulators, and I'm curious, you were here in Asia as this was happening. I imagine that the Japanese regulators needed information. Did they come to you? Did you get in? How did you react with regulators? How were regulators reacting in headquarters? How the SEC and others reacting with Lehman? What kind of reports were you getting? What was that dialogue like between Lehman and the regulators?
Well, there are two aspects. We had maintained always good relation with the regulators, especially internal audit when they come on inspection. We're an important department for that. But officially, they're not in a position to get information on what's going on at global level. And they didn't, and they wouldn't. They had a concern because there were about 1,300 staff in Tokyo. And also because of the global interaction of the markets, they need, but I think they realized very, very quickly, probably from July, that the problem was really large and not, something to try to discuss in Asia. Even if they get information on what we are told, that's not a lot of value for them. The other way around, I may have tried to get some information, not information, but some view from them, or what's the feeling, etc., just to comfort. But it was very difficult.
You were going to regulators here.
It would be the other.
So that suggests that you weren't getting very good information at all from New York. You felt like you would.
Yeah,
Did communication broke down then?
It didn't broke down, but in terms of facts, if you like. From August and they were basically no facts coming in. It was really uncertain.
Well, very interesting. Must have been very tough times.
I should complain to my wife, I think, and my mother on the reason why I was not able to retire before the crisis.
I see. Yes, you'll have to explain that. Well, watching from the outside, it was kind of thinking about retirement, and it was not an easy thing to watch at all. You didn't have time at the end to talk about something I was looking forward to hearing more about, and that's your views on where the next crises might be. Now, you touched a little bit about on the developing world, but I wonder, is that the only place? Or are there more to be said about that? Because we saw some charts, but is it an area we should be worrying more about? Do you see asset bubbles there?
You know that's Mr. Branson is offering a travel to space. It's a little expensive, but that might be a place where we don't have a bubble. No, more seriously, the situation in Europe is very, very concerning because it's a deadlock politically, as you have seen, and the solution is political at this point. So banks, I can tell you that, well, French banks, they are selling massively, as much as they can, the assets they've been selling for 6 months. So they are limited by the liquidity, by what they can sell, but they try to get rid of sovereign bonds that they have accumulated. They try for 6 months. And they are really, all banks are in a difficult situation. Now, you think where growth can come from? Probably emerging countries. And the BRICS, the 4 big emerging countries, they make something like 18% of the world GDP. So if you add up to the G7, that's about 70% of the world GDP, a little more, maybe 80. And the rest is very, very fraction spread over. So you don't have a big economy or something that could drag the whole thing. And maybe you've seen through some graph that there is obviously a real estate bubble, especially in Brazil. China has already busted the bubble. It's already bursting. There's still some way to go, but it's basically totally burst out. And an indicator of that is in February, so it's months ago, they have stopped publishing a real estate index that they used to publish. That's a sign it already collapsed. And the economy, as you know, is very difficult. So I think those emerging economies, unfortunately, they cannot drag growth and attract growth by themselves yet. They have some areas of wealth, but if you accept China, well, there are about 200 or 300 million persons that have maybe, well, with a lot of differences, but in average, maybe $15,000 of GNI or GDP per capita. But they are facing a recession because they are heavily dependent, especially on exports to Europe. You're left with Russia, which is basically an economy, I believe, with a totally, well, there's a camera, but it's between us. My view, I don't think things have changed a lot, but it's a totally corrupt banking system. And it's always on the verge of collapse. It still exists because there are deposits. They are living on deposits, but it's really inefficient banking systems. And when they want to collect a claim, basically they need to have a gun. I remember I had a very official meeting with the Central Bank of Russia inspection team some years ago. And one question they asked was, when you have to inspect a branch, do you bring a gun? Because they were concerned about security matters. And they were coming from, to France or to Asia or to make a tour. And we took them around and so, sorry, we're not, maybe I should, but we're not living in the same world. So this is very different situation. Brazil, I think it's sort of close to being a very strong economy. It should, maybe Brazil has a chance and its banking system is not, they don't have I don't believe they have a lot of assets outside. And they should be relatively comfortable, but they face a real estate bubble, and they have assets on this bubble. The only good thing, the good thing with the Brazil economy, as you know, is that they exported off a lot of food. And that's of course Russia too, but Russia is, for its growth, it's depending on energy basically, and metals. But Brazil is really has a lot of a huge potential in agriculture and food and food industry, and they can go down the channel and the distribution channel and the production channel and develop a strong economy from that. But we've seen the situation. I think for the next, I don't know, I mean, no one knows, very difficult situation. Probably for the next 2-3 years. Next year we got very tough time. And the 2 years after, either we have some growth with a lot of inflation, either we have no growth, and that will be true for emerging countries and for developed countries. But you know, the worst is never sure. So I had a manager who used to say that. So maybe we should be optimistic. And as an internal auditor, I'm pessimistic. So maybe I'm not the right person to.
I see. You think you have a bias. Okay.
Yeah,
Well, that
definitely.
was a fairly grim picture of what we can expect to see. You mentioned at the beginning some about European banks. You also talked about governance. Now, do you feel like they have the level, the quality, the character, the systems of corporate governance that are helping them now, that are helping them through this crisis, or do you see failures in the way that we saw at Lehman and its reaction in relations with the U.S. Government?
Well, there are two good things. Is in most European countries, external auditors have to alternate and be changed every 5 years. In France, a firm has to have 2 external auditors. That's a little better, but because there are limited number of large audit firms now in the world, it doesn't make a big difference. The other thing is that this crisis now, of course, things have been moving up from product to product, but is on very simple product, which is sovereign bonds, which, well, we can discuss that, but what is the purpose of a bank that get funding in the market or deposits and that invest in sovereign bonds? That's not really good, but it's a product very easy to understand. Governments so far are not issuing bonds with sophisticated options attached to it. Maybe it will come one day because they have to do something about their debt.
Inflation protected, inflation-linked
Yeah,
bonds now,
yeah.
which they
Yeah,
might
they
come back to
do
haunt them. We'll see.
Exactly. Yeah, definitely. But it's easier for management to get through it. But globally, you know, the boards are limited in their efficiency. They don't have enough power. They have actually less power than in the United States. There's no, not in all countries, but there's no obligation to have external auditors. Usually now, external directors. Usually the board will be made of external directors, but if you take the case of France, which is the one I know best, is basically they tend to know each other from one sector to another, and it's a very small world. So if there is a problem, the risk that it's not properly addressed, or they try to procrastinate the solution or hide it a little, or is still there. It's improving, but I think it's there's no. I think on either part, there's no. Europe has no lesson to give to the United States. Very far from that. And I think United States missed an opportunity to give some lessons there. There's good thinking and system, but it's not been applied the right way, maybe.
U.S. does not have much credibility right now in financial.
Well, it's going to change.
We'll see. We'll see. Okay. Jean-Paul, thank you.
Thank you
very
very
much.
much. Thank you
Much
very much.
appreciated.
Thank you.